Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem within Excel related to a consolidation where we have a parent-subsidiary relationship. The parent have a controlling interest of the subsidiary, thus the consolidation of two sets of books that are going to be combined together as if one. The parent owns less than 100%, however, of the subsidiary. We will have a difference where the fair value is going to differ from the book value. We will be considering this in year one. In other words, we're going to do the consolidation right after the point in time that the purchase took place. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We're going to have the information to the left. We're going to enter that information into the blue area down below and to the right, including the journal entries. We're going to have our trial balance for company P and S that we will be consolidating. We will total them up and we'll have our consolidation or elimination entries, and then we'll take a look at a consolidated balance sheet. Let's go back to the left, back to the data. P purchased a percent of S on December 31st, 2000x0. The percent was 70%. So 70% purchased, and the amount that was paid is going to be the $89,600. The fair value of the non-controlling interest is $38,400. So the fair value then of the non-controlling interest, $38,400. Book value of assets and liabilities, same as fair value except for. So in other words, at the point of purchase, we're going to say that, what this is happening. P is purchasing S is common stock and getting a controlling interest over the 51%. So at that point in time, we're trying to think, okay, if I looked at S's information, because we're going to think about the consolidation here, and I looked at each one of these accounts with regards to it, are they at fair value versus book value? And we're going to be, needing that information for the consolidation process. We're going to say yes, the S book value accounts are the same as fair value, except for, in this case, we have the fair value of the other assets here are at 84. So in our S's trial balance, they're on the books at the other assets, the 78. So they're higher here on the fair value. And the building, 203. Remember, when you're looking at the building, you got to take the net of the building, the 261 minus the 73,000 for the 188. So those two things are higher for the fair value. The intercompany, then there's an intercompany accounts receivable and payable, meaning we're going to say that basically S owes P, let's say here. So we have a receivable that's too high and a payable that's too high. So we'll have to deal with that as well. We've seen that in the past, no big change there, but just an added detail we'll have to work out here. Consolidated financial statement just after the purchase. So what we're going to do then, we're going to basically think of this, I would think of this as like a year zero problem, right? In that the consolidation took place right now, and we're doing the purchase took place like right now, and we're doing the consolidation right after the purchase. So in other words, there's no income statement accounts we have to deal with. The new thing that we have to deal with, of course, here is the non-controlling interest. Not only do we have a non-controlling interest, but we have a non-controlling interest and a difference between the book value and the fair value that we'll have to be accounting for as well. So let's then think about the calculation of goodwill and how this will work out too. So we're going to go down here. I'm going to do our standard kind of little calculation. I'm going to say, all right, well, the book value, what's the book value of S? Well, this financial statement over here is just, right after the consolidation. So this is basically S's books at this point in time. So we can either take the assets minus the liabilities, which would be the 107, or the equity, that would of course equal the equity at the 107. So I'm going to pick up those numbers. I'm just going to say this is equal to the sum of, and I'll just say the assets minus the liabilities over here. We'll just go summing up the assets and the liabilities, and the debits minus the credits and so on, gives us then that 107. Then we have the fair value over the book value. So that means that these two amounts are higher than the book values over here for those two amounts. So what I'm going to do is I'm going to add these two up. They add up to the 287. And then we're going to subtract out what's on the books for S, which includes this number. And then I'm holding down control, this number and this number. So, and these two are subtracting because it's, the building minus the accumulated depreciation. Let's do that with a formula in Excel so we can practice our kind of a little bit trickier formula here. We're going to say, all right, well, I want to take equals the sum of these two. Let's sum those up. And then I'm going to close up the brackets. And I'm going to say minus. And then let's put brackets around this because I'm going to have to do something more than just a sum. So then I'm going to go on over here and say, all right, what do we want over here? We want the other assets. I want that one. So that plus the sum of, and then I'm going to be picking up these two, which will net each other out, which will actually be a subtraction problem. So here's the formula up top. I need another bracket here, I think. Okay, so again, the math is just going to be the sum of these two minus the sum of these two, or the sum of these two minus this plus this minus this, right? This group of numbers minus that group of numbers. And then this is the formula that we will be using just from an Excel standpoint to do that math. All right, so there it is, the 21. Then I'm going to sum these up. So I'm going to say, all right, here's the sum of these. That's going to be the 128. So that's going to be like the fair value, right? The fair value of the entire company. Now, we're looking at the fact that we only purchased, the purchase was only for 70%. Now, you got to be kind of careful here because you would think that you could just take, all right, well, I'll take 70% of that. But notice they gave us the data here of the non-controlling interest. They told us what the non-controlling interest was. So what I'm going to do is I'm going to take the non-controlling interest, the 38,400, and I'm going to say, all right, this is the non-controlling interest portion, the 38,400, which is that number. And then I'm going to say that means the fair value of the controlling interest must be the difference because this is the total. So the non-controlling interest fair value is that. So if we subtract that out, there's the fair value of the controlling interest. Let's compare that to what we paid. How much did we pay for this thing? Because I'm considering ourselves to be P. We're the purchaser. We're at 89.6. So that means there's no goodwill here, all right? So notice the goodwill calculation, similar goodwill calculation, a little bit more complex given the fact that we only purchased part of the organization, but similar thing, right? We got the full book value plus the difference in the fair value over the book value. There's the fair value. Then you would think you would take that number times 70%. However, if the problem gives you the fair market value of the controlling interest, then you're going to use that and say, well, if that's the controlling interest portion, this then would be, then if that's the non-controlling interest portion, if the problem gives you the non-controlling interest portion, you use that. And then the difference then is going to be the 89.6. That then would be the proportion that we would think that we would pay for if we paid for this thing basically on a book value if there wasn't something else on the balance sheet, such as goodwill, that we would be paying for. And in this case, that is indeed the case. So we don't have to worry about goodwill here. That is nice. So okay. So now we're going to go back up top here and do our journal entry, standard kind of journal entry, standard kind of thought process that we'll have here. But now we have this added complication of this non-controlling interest that we will be dealing with. So first off, we're going to say, all right, now we might want to think about the equity method journal entries here. But really not much has happened right now because it's just basically been a purchase. So when the equity method took place, we're going to say, all right, well, that means that P must have purchased an increase of this number. And they purchased it for, of course, the 89. So that's how much they paid. And if they were to pay cash, then the credit would be going to cash. So let's just say cash. I'll just type that in. So that's pretty straightforward. That's where this number would be coming from, right? Because there's been no activity since that point in time. So then we're going to say, all right, well, I know that number needs to basically go down. So I usually put this number on top, even though it's going to be the plug. That's just what I've been doing. So I'll keep with that method. And then I'm going to think about removing basically the equity section for S, right? Which is going to be this and this. So I'm going to remove the equity section. So I'm going to say, all right, this is going to be equal to the common stock. And this, I'm just going to copy this and paste it down. That'll be the retained earnings. And then these down over here are credits. So we're going to debit them. So I'm going to put them on the debit side. I'm going to say negative of. I'm going to pick up that 31,000, negative of the 31. I'm going to copy that and paste it down here. That'll be negative of the 76. I'm doing this a little faster on the Excel just to, pick up and practice Excel. So there we have that. Then I'm going to be taking a look at the non-controlling interest. That's going to be the other thing we have to break out here. So I'm going to say, because again, notice this investment number up top is breaking out the equity method. So that's only representing the portion that is P's portion, right? So that means I need to break out that this would be the equity. If it was 100%, that's what we would use. But now we got to break out this non-controlling interest, all right? So now we're going to say, all right, the non-controlling interest, what's that going to be? So let's say what that is. We're going to pick that one up. Now, the non-controlling interest in the net assets is basically, it's just what you would think, right? You would say, okay, well, the net assets are this minus that, or the 107 assets minus liabilities, or in other words, there are the 107 equity, and the non-controlling interest is 30%. So you'd think if you pulled out the giant calculator, you'd think it would be 107,000 times 0.3. And that'll give us the 32,100. That's going to be our amount. Let's do that with a formula now. So I'm going to need a credit over here. These are debits. We're going to have to temper this out with a credit and represent the portion here that's going to be the non-controlling interest in the equity section, which is going to be a credit. So I'm going to say, let's say negative sum. Now note, you might take, well, let's take the negative sum over here. I'm going to say assets minus liabilities, or you could say the equity section, or in this case, you could say the negative sum of these two numbers, which represent the equity section, right? They all do the similar thing, but I like to just show that obviously we're taking the non-controlling interest of, it says the NA, which represents the net assets. So let's take the net assets over here, so that portion of the calculation, times the, and then I'm going to say to use a formula, 1 minus the 70%. 1 minus, which is the 30%, of course, right? So there's our formula. So we have all, formula numbers. There it is. Now I'm going to put the plug in the investment account up top. It's not going to be perfect. It's not going to make this 0 yet, but that's what I'm going to put there at this point in time. Why won't it make it 0? Because we have this difference between the book value and the fair value of the other assets in the building and equipment. We're going to account for that in a separate journal entry. Again, you might want to do this all in one large journal entry. I mean, I kind of think it's easier sometimes to do that instead of kind of breaking out the investment into multiple different sections. But at the same time, it's good to analyze it with multiple sections. So let's do our trusty negative sum formula, which is our plug formula. And that should put us in balance. So there it is. Let's post this out. So we have the investment in S. We're going to go on over here. And we never totaled this thing up. I didn't total it up. Let's total it up first. So we have obviously P's books, our trial balance, S's trial balance. Let's sum those two up as we've seen in prior examples. And then I'm going to go on this one and say Control C, down arrow, holding down Shift, down, 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 up. Control V, pasting it. That puts us back in balance down below. Let's post out our journal entry now. So now we're in the investment. So I'm in the investment. I'm in cell L9 equals. We're going to be scrolling over to that 74,900. 74,900. Now we're going to be taking a look at the common stock. So common stock down in L12 equals, scrolling over to that 31,000. And that, of course, brings down the 31 or S's portion. So 72 plus 31 is the 103 minus the 31 brings us back to the 72 or P's portion is left. Then we're going to go back to the next one, which is retained earnings equals, picking up the retained earnings. So once again, we have P 205, S 76, total 281 minus S 76 gives us P 205. Then we're going to go to the non-controlling interest and say equals and scroll on up to the non-controlling interest. So get that out of the way so you can see it. And there we have the non-controlling interest there. Okay, so now we're on our way, but we haven't brought this one back to 0 yet. And let's make this account a different color just so it stands out to us here. So I'm going to make it yellow and red. So it kind of, there it is. That should be 0 at the end of the day. And so until it is, it'll be yellow and red, and we're going to focus on it. All right, so then what we need to do then, the reason it's not, of course, is because we have this difference between the other assets and the building and machinery. If we had not had that difference, then we should be okay at this point in time. but because of that, we have to keep going. So here we go, which we get to do. It's going to be great, good times. I'm happy about it. So we're going to say that means that the other assets, we're going to increase that. So the other assets have to increase by, and then it's going to be the difference. We said it was 84 over here, the fair value, and on the books, it's 78. So we're going to subtract those two. Let's do that with a formula. So I'm going to be here. I'm going to say this equals this 84,000 minus the 78,000. And that's going to give us the 6,000. We're going to have to increase it by the 6,000. We're going to do the same for the building and the machinery. So we're going to pick that up. And then we said it should be the fair value of the 203. And then be careful here because you got to take the difference between these two. So minus the 188. So I'm going to say, all right, then that means this has got to be equal to this 203 with a formula. Let's set minus the sum of these two, which is going to be subtracting them out, the 261 minus the 73, and that's going to be the 15, right? All right, and then the other side is going to be going into the investment account, so it's going to go into the investment account. However, not all of it's going to go into the investment account because not 100% of it is owned. Part of it's going to have to be affecting then the non-controlling interest here. So we're going to say, okay, we're going to have to break that out. How are we going to break that out? Well, the 70%, so if I add these two up, 21,000 times 70% is going to be going to the investment here, and then the difference to non-controlling interests. Let's check it out. I'm going to do that with a formula. I'm going to say negative sum, the negative sum of these two, closing up the brackets, times, and then I'm going to pick up that 70%. So there we have that. Now, this formula could either be the plug formula, the negative sum formula, or we can take 30% of those two numbers, right? I can take negative sum. Let's do it this way just to emphasize the point of 30%, closing the brackets, times, and then I'm going to put brackets and say 1 minus the number that's given up here, just to use, the data that's given, in close brackets, and there we have the 6,003. And obviously, if we were to add this all up, it should be in balance, meaning adds up to 0 debits minus credits. Let's go ahead and post that out. So post that out. And notice this is how you need to be thinking about this now. In the prior problems, we had this change, which all would have been going into the investment account if it was 100% owned. But now every time we have this kind of change, we got to say, okay, then this one's going to get the 70%, the controlling interest, and then the rest is going to have to go to the non-controlling interest. So in other words, we're making the financial statements basically on a fair value at the point in time that the purchase took place. So in other words, increasing these accounts to the fair value at the point in time the purchase took place, not taking into consider controlling, non-controlling interest. And then on the other side, basically the investment side and like the equity side, that's when we're going to be considering the breakout between the two. All right, let's post it out. So we're going to go to the other assets. So we're going to be in the other assets up top. We are in L5. I'm going to say equals. Scroll on over to that 6,000 and be picking that one up. Then we have the building and the machinery. Building and the machinery in L7 equals, and we'll be scrolling on over and pick up that 15,000. So there's the 15,000. Then we have the investment in S. So the investment in S, that bright yellow and red one that we made, I'm going to say F2 plus F2 because there's something in it. Go over to that 14.7, and that looks like the same number. It's going to bring it down to 0. That's good. That's what we want to see happening. I'm going to go down to the non-controlling interest in the net assets of S. And I'm going to say F2 plus F2. We're going to be picking up the 6,300. 6,300. There we have it. Now, this is the major components, right? So this is the major components with the new thing here being non-controlling interest, less than 100%, and the fact that we had a difference between the fair value and the book value of some of the assets. However, we didn't have goodwill involved here, and we only had to deal with this non-controlling interest on the balance sheet because we did this non-controlling interest thing right after the point in time that the purchase took place. So next time, of course, we'll take a look at a problem where we have possibly goodwill to mix up in our problems here, and we'll have income statement accounts activity that has happened where we'll have two non-controlling interest accounts, one on the balance sheet, one on the income statement we will have to account for. All right, we had a couple other things we got to take care of here before we're done, though. but that's the major components. We've seen these others in the past. One is that we want to net out the depreciation again. So this 73,000, as we've seen in the past, at the point of purchase, which is this same date, we want to net it out and show it as just one line item for S's components here, like as if it was a purchase, basically. So that means we're going to remove that 73. So I'm just going to say, all right, we're going to debit the accumulated depreciation then and credit the building and the machinery for the amount of the 73. So we've seen that in the past. I'm doing this pretty quickly because of that. So there it is. We got the 73 there. I'm going to scroll on over. We're going to be picking that up in the accumulated depreciation. So there it is here, and we'll pick it up here, the building and the machinery. So let's go on over to the building and the machinery. Something's in it. I'm going to say F2 plus F2. Scroll on down to that 73. So we've netted those out. And then we had one more intercompany transaction, and we've seen this in the past as well. We have this ARAP intercompany transaction. In other words, we're going to say that in the accounts receivable for P, there is a receivable from S of 12,600, and in the payables from that are on S's books, there's a payable that's 2P for that amount as well. That means the assets and liabilities, when we add them together, are overstated for those accounts, and we'll just reverse those out. So I'm going to say, all right, that means that the accounts payable's got to be debited to make it go down, and the accounts receivables got to be credited to make it go down for the amount that is included. That's going to be the 12,600. 12,600. Doing this pretty fast as well because we have seen this in the past as well. I don't think this is the most complicated component of the problem, but we want to just add more, complications as we go here. So we're going to say, all right, then that means, and notice that a lot of things in accounting any one thing isn't complicated. It's often the fact that you have so many things that you don't know how to approach them because you're just overwhelmed with a bunch of fairly simple things, but there's a whole lot of them, right? That are, how do you approach it? So now we're in L10 equals, and we're going to be picking up the 12,600, and then we're in the accounts receivable up top. The accounts receivable. Undo. And then we're going to pick that up in L4 equals, and we will pick up the receivable, and that'll make it go down. So there we have it. I think that's it. This account is now at 0, so let's go ahead and make it back to like normal color. I'm going to paintbrush it. All right. And then let's just take a look at our financials. Now, the only thing different on the financials is really this non-controlling interest. So let's just kind of break that out on a balance sheet and consider what that would look like. So I'm going to do this pretty quickly because I'm just going to, pull over. All these numbers are basically the same. So I've got all the numbers here. I'm just going to say this equals the assets, cash. I'm just going to copy that and then holding down Shift and then Control V. I'm going to paste that down, and that's just picking up all the assets here. Then the total assets, I'm going to put in the outer column equals the sum of these items, the assets, and that adds up to the 1,017,700. Let's go ahead and put an underline here, which should be underlined for you already. Let's do the liabilities. These are liabilities. They have credits here, so we need to flip the sign. I'm going to say negative sum to do so of these items, closing up the brackets. Actually, not the negative sum. What am I doing? They got to do this one at a time. Negative of that one, negative of that one. Then we'll sum them up in the outer column. Sum of those two. So that's the same as, normal balance sheet. And then we have the item down here in the stockholders' equity where we have the controlling interest and then the non-controlling interest. So the controlling interest, I'm going to pick up the common stock, the 72,000. We're going to pick up the retained earnings, the 205. You'll note these two accounts basically represent P's portion because we removed S's portion. And so that's the controlling interest, right? We're going to say, all right, this is the controlling interest, is the sum of those. And then the non-controlling interest, of course, is going to be the 38.4, representing the equity section of the non-controlling interest. We adjusted it, so that's not exactly that, but the non-controlling interest being the 38.4. So there we have it. If we then sum this up then, or add this up, we're going to say the 7023 plus the 384, and that's going to be then something. Did that happen or something went wrong here? Hold on a sec. Sum of these two, that's going to give us the total equity. Then we're going to take the 7023 plus the 315.4. All right, so now we got the 1,017,700, the 1,017,700. So key component here is on the statement of retained earnings now, where we're showing the component that is the controlling interest. Because remember, the idea here is being, look, P has control over the allocation of the net assets given they have a controlling interest. So they can assign what to do with these net assets. So you want to say assets minus liabilities are representing not just their portion, but all of it, because they kind of have control over what to do with it. But then you want to break out who has claim to those assets, and you can think of that kind of in the liquidation process. Well, if the company was to liquidate, for example, then you would think the controlling interest has claim to basically the 277, and the non-controlling interest the 38.4, and that's going to give us the total of the 315, which of course is the assets minus the liabilities.